Welcome to another episode of the Australian Retirement Podcast, coming to you with my friend and co-host James O'Reilly from Northeast Wealth. Welcome, James.
Thank you, mate.
Another exciting episode for your Thursday evening, probably. Maybe you're walking the dog, maybe you're mixing up a drink to watch Thursday night footy. Who knows? But we've had some good questions come through in the last few weeks, and as always, please go on the community. We're always trawling through the YouTube comments. We'd like to talk about feedback questions. Same thing in our eyes. And I believe you've got yourself into a bit of a predicament this week when it comes to your social life.
Yeah, it's not a predicament.
And an expensive predicament.
Yeah. So we bought some Oasis tickets quite a little while ago.
Willing buyer over here too. If you happen to need to get rid of them.
I do. Yeah. And but you might have the same problem depending on your priorities.
Yeah.
So I bought these Oasis concert tickets. Can't wait to go. And Lou made the point that it might be nice to go on a Disney cruise,
which looked fantastic, by the way. Like multiple restaurants, Toy Story, all the characters there to play with for the kids. Yeah,
sponsored by Mickey Mouse.
Yeah,
yes, but we the problem was that of course it clashed, and we're at the Finn's.
How do you
look, mate? Don't.
Do you explain to the kids the sacrifice that you're making? Like. The last time you'll ever see, probably the first and last time you'll ever see Oasis.
Yeah, maybe. Yeah, I'd be surprised if they get to the end of the actual tour. To be honest, surely they'd be bickering like cats and dogs by now. But yeah, so it was just the only option was that date. We've got that intricate age. Finn's 7, Grace is 5. Like for Grace, she's probably got a couple more years of this. Like we're singing Moana songs most nights, so we've got plenty to go. But Finn's starting to check out of this sort of stuff.
Yeah.
So
hanging him in there.
Yeah, so we think that this is probably, we had a good conversation about it and sort of mutually agreed, this is probably the last year that we could do it where they'd both have a proper good time. So I did propose to Lou, why don't you just take them on the cruise and I'll hang and, go to the concert and just have an amazing weekend. And she shot me a glare that I've seen a few times before the conversation stopped really quickly.
As they do.
So yeah, I'm off to the Disney cruise and I've got 2 tickets to Oasis to dispose of.
I've got a good, and as this came to, someone found this on Instagram or on a podcast or something, then this could be an idea to explain the sacrifice you've made to your children. Is people suggested, so don't give your children access to it now, but set up an account where you can email memories and funny things that they did. Like my kid walked into the bedroom one morning and the first thing he said was, "Oh man, I forgot my Gatorade." And it was like one of these ridiculous things from a 4-year-old. Like he's not a 17-year-old who needs a Gatorade. But send these things, and I think this sacrifice, explain that you've missed out on the last time Oasis is ever going to play in Melbourne to go on a Disney cruise with your children, and maybe bring it up at their 18th and see if it resonates.
It's a great idea, but I don't want the first of those people. He's like, oh, what a nice thing for my dad. He opens the very first page and it's just fully expletive laden about.
Exactly.
Yeah, so maybe I need some nicer stories to open with.
And you've got a bit of a tan too, so you can't really complain too much. This sounds like 2 cruise or warm weather holidays coming up.
Okay, well, firstly, let me defend that. We're going from Melbourne and then we're doing basically a loop in Bass Strait.
Yeah. It doesn't go very far. It doesn't go in international waters.
Yeah, and it's in October, so I don't think we're necessarily going to get, I'll get sunburned still based on my complexion, but
no duty free.
But yes, I was away. We recently went to Bali. Lou's 40th was only a couple of weeks ago. And
happy birthday, Lou.
Yeah. She never listens to these, but sure. So she a little while ago, maybe 12 months ago, she said, "Look, I would really like to have my 40th overseas." And initially she pitched Italy, but I managed to grind her down to Bali.
Yeah. We can't go on the cruise and go to Italy. Yeah.
Correct. So yeah, we had a great time. One interesting thing happened, which I think is very contextual to finances, is that we were coming back from, we're in Canggu, we're coming back from the beach, and we got a driver. Yep, absolutely. Let's head back. And just in the distraction of getting the kids in the car and all that sort of thing, I missed the fundamental thing which you should do, which is just organise the cost at the front end.
So everyone uses Gojek or all these other things in, yep.
Correct, yeah. So mistake made. So we get in the car and we're driving along. This is one of those taxis without the meter. But also I'm thinking, hey, how bad can it be? Let's get on with it. And it's not far. It's only 2Ks, which in that area takes about 45 minutes. And we got there, and the kids are bailing out of the car and everything. And he says, "Oh, that's like 70 bucks, yeah, something like 700,000 rupee or something." And I gave him a smile and said, like, "Come on now, what's it really?" And he just deadpanned me and said, "No, that's the cost. It's 70 bucks." And it was an interesting little stalemate because, like, in my mind's eye, I'm like, I'm not paying 70 bucks, but also in my own head, I wish that I just organised all this beforehand. Yeah. But he was absolutely adamant. He had an air of like, if this is going to escalate, I'm fine with escalating. You owe me $70.
Is that pre or post the hamstring?
Yeah, thanks. It's post hamstring.
Yeah.
So I'll be lumbering.
It's a different decision.
Yeah, that's right. No, so worst case scenario, I've got to pay the 70. I'm not. Yeah. So like in the final analysis, I said, look, I'm going to give you one more crack at this. Like, propose a serious number to me, or we're done. Like, so in the end, it was something significantly less than 70, but probably still more. But the thing that struck me when I was thinking about this scenario later was the fact that what he was doing there is something that I think traps a lot of human beings, not just in a bloody taxi in Bali, but for big financial decisions, all sorts of stuff, which is that a lot of people don't like confrontation. Yeah. Generally speaking, human beings, most reasonable human beings don't like confrontation. Some people try to avoid it at all costs and are really uncomfortable in that environment. And I can't help but feel that there would have been a lot of people that would have handed over that $70, just thinking, I think this is a fair bit, but I'm just not liking how uncomfortable this is.
Particularly in front of the family.
Yeah, that's right. And so it really stood out to me, that idea of having the confidence to be able to say no. And we were talking a little bit earlier about timeshare, right? Like timeshare is like the best example.
I've never been in one. I'm afraid I'd buy it.
Yeah, that's right. It's like the best example of this. They're trying to find people and bring them in and pitch to them and give this really tight pitch where you don't have a lot of wiggle room to say no, other than it's too expensive for me and I can't afford it, which is a pretty vulnerable thing to say. A lot of people find those words hard to say. And so a huge amount of people go in saying, I'm not going to do it, and come out saying, kind of justifying to themselves why they made that purchase. Even though it wasn't the best purchase. If they'd waited until tomorrow and had no pressure and got a call from timeshare saying, are you interested? They'd say, no, thanks, and hang the phone up. But they were sitting in that room, in that boiler room type scenario, huge sales pressure, and they just weren't confident saying, no,
I'm leaving. Well, they've done that sales pitch thousands and thousands of times before. It's incredibly prepared and specific, and it knows exactly how to get you to make the decision, which is always scary. Yeah, it is. Yeah. So if you're like, lesson learned for me, like, luckily I was able to kind of avoid that one, but to the people that are listening, like, I've got mates in this category through and through. If you're listening and you can reflect and you're thinking, I'm probably one of those people. I find it pretty hard. I don't like conflict, and I'm not best in that environment. This is a muscle that you can work on. I extend this to other hotel stays as well. There was a good, there's a Instagram account that has, pretty funny stories. One of them is in Bali and being afraid to go and check how much your tab is at the reception, because when you're on a holiday, you just put everything on the room, and it's more about don't hide. And this is about, I think, good relationship with money. Don't hide from the money you've been spending. Just be upfront about it, so there's no surprise at the end.
Yeah.
But we do get into that, travel holiday mindset where we want to just forget about it and ignore it and deal with the problem when we get back.
Yeah.
Which isn't always the most healthy approach.
Yeah. Don't ask for the bill at the end.
Ask, just get an update halfway through, and you're usually not going to change your behaviour anyway, most likely. But at least know where you stand and be prepared for what comes at the end.
Now, you had a ripper question here around financial advice.
Yeah, and I think, and this might be, it felt refreshing to do these meetings when we do them, but maybe it's even helpful for people that are listening as well. That I had a question, ultimately it was a question this week. I don't even think the person was asking the question. We kind of asked this question ourselves when they came on. But it is, do you always need financial advice? Like, there's a feeling, maybe it's the media, the lack of the inaffordability, the difficulty in accessing financial advice, that a lot of people, it seems like lots of people think they need financial advice all the time. So I'm not saying that financial advice doesn't have value, but it doesn't, in going, long story short, you don't always need financial advice right now. You've got a bit of a framework that goes through it. But for context, we met a lovely couple in their late 40s, early 50s, so starting to think about retirement. And they'd actually, because they'd been doing externally quite well, they appeared well off, they were saving money. All of their friends were almost pressuring them and suggesting they need to get financial advice. So suggesting all the time, go see an advisor. You've got all this cash flow. You've got this. You should be doing this. So they came to us. So they're late 40s, working the kind of jobs that they're comfortable with, reasonable income, limited debt, 2 investment properties, inheritances, but not going to come for at least a few years now, and knew exactly what they wanted in retirement. They could probably retire as soon as they want to. They looked at super contributions. They'd done some of those. They had maxed out their concessionals. They had pretty competitive superannuation funds, and had no plans to sell investment properties or do anything else. Everything was performing, traveling well. So we went through a 15-20 minute meeting, asked a lot of questions, and realized that we could provide a financial plan to them, and they'd have to pay the normal fee because of the time and compliance involved in it. But ultimately, we'd be simply confirming the strategy that they already had in place, and the additional value we'd add on that initial piece of advice just wasn't significant enough, in our view, that's continue with the status quo. And being able to say that was quite refreshing.
Yeah.
And I mean, there's a background in the industry where it's find a solution to someone that doesn't have a problem. Where this industry came from was selling products essentially for commission, and it's good. I hope it happens more and more often that less people it's not reliant on product anymore. The lesson here is that if you've got you've got a fairly good direction, you understand the strategy, you're taking advantage of most things, and you're aware of it, and you've actually thought and considered and put a plan in place, then sometimes advice isn't going to be beneficial at every stage of your life. No doubt there will be at some point. If a property's sold, if inheritance come through, if there's events with children, businesses, all these other things start to come to fruition, then definitely that's probably when the trigger for advice would be. But it's not going to be at every point of your life in your 40s, 50s, and 60s. You have similar examples?
Yeah. I'm with you in the sense that I love when these people come through. If think back to when we started advisory 20 years ago, the questions that we were getting, like you'd sit down and explain to someone, then hey, you're able to put some superannuation or some money into your super and claim a tax deduction, and they'd say, oh, I didn't realize. Yeah, that was a really common response then, and you'd be explaining how a tax deduction works, and financial literacy has evolved in a wonderful way over
credit
the last
to you.
20 years.
Yeah. Credit to us for creating this.
And Rask, Owen in particular, and the Rask team do an incredible job. There's a lot of great podcast content. There's information has become so much more available. It's bloody awesome.
They're definitely more informed before they come to us.
And now we're dealing with more complex, like better quality problems. That's I love it. So when you sit down with someone, recently I had this where they came to us and same thing. They said, look, he said, I listen to probably 8 hours of financial podcasts every week. I'm just constantly listening. And we said, oh, that's really cool. And I just started asking more questions about their finances. And got to the same conclusion. Like, hey, you don't need me. You're doing really, really well. So we have a similar framework as you were talking about. In my mind's eye, the people who are going to best be served by a financial advisor are people that need advice with either or. Firstly, direction. I commonly meet with people where you say, hey, tell me about what you want your life to look like in the future. And they've got kind of a rough idea, rough to the extent that if you take them through that same exercise.
Age, have this much in retirement, have this much money, travel here, that sort of thing.
Correct. Yeah. If you, I'm taking people through that exercise at our businesses as part of our offering, and it's surprising how many realizations are made during that, which is just a reflection of the fact that you've got a very high level understanding of it only. You're not getting granular about it. So firstly, your direction, as you said, where are you going? Secondly, strategy, not just the strategy, the financially optimal strategy, like how much should I put in super and how much money should I invest and where should I invest it? But also just more broadly, how do all of those actions contribute to my direction and enhance the likelihood that I will actually be able to do the things that I want to do? And the last one here is accountability. The things that I say that I'm going to do and the plans that we have, how often are they executed?
Do we have checking back in?
And do we have vernacular wording along the lines of saying, oh yeah, we did look at that a few years ago, and then we just kind of never got around to it. If you're the sort of person that utters those words, you're probably better suited to a financial advisory relationship than someone that says every time something comes up, we just action it and get on with it.
Because part of that advice process is almost coaching, or that sounding board to continue to go backwards and forwards and trigger the things that you're too busy or don't have the bandwidth to think about.
Yeah, 100%. Now, if you've got these right, if you have clear direction, really well defined, you've got strategy that is not only financially optimal, but is enhancing your ability to achieve your direction.
Yeah.
And then you're also accountable to your financial commitments and behaviors and so on. The only thing that I can add to this is optimization.
Yeah.
So it still sometimes can be beneficial to sit down with an advisor and say, I feel like I've got these 3 things right, but I'm open-minded that perhaps there's some elements, some strategic things available that I don't know about.
Are you in an expensive product? Do you have the wrong insurance policy? All these kind of things.
That's right, yeah. The trap for me, I think, is that a lot of times you have someone come to you that says, look, things are really good. We're just thinking about how to optimize it. And then when you ask them about their direction and strategy and accountability, you're like, well, you need help with all 3 of these things.
Yeah, none of them are there.
That's right. So this is not optimization.
Yeah.
So I don't know who has the expression, but that one of my favorite expressions is we all have a blind spot the exact shape and size of ourselves. Yeah. Now, incidentally, I tried to work out.
So good with these expressions all the time.
I tried to work out I tried to attribute it to someone. And I typed it in, and Google gave me an AI overview that said, no, that statement is not accurate. Everyone has a naturally occurring blind spot in each eye. These blind spots are small and yada yada. And that's brought to you by Specsavers. So this is an example where AI has not quite got it. But more broadly, if we're thinking about your financial situation, have the awareness to consider, do I actually do these things well?
Yeah.
It's that we've used the metaphor before about going to a personal trainer. If you're really clear about not everyone needs a personal trainer. Yeah. Like if you're rocking up to the gym consistently when you say you're going to, your workouts are intense, you carry that on and you hypothetically diet well and you can do all the things that you want and not tear your hammy when you go and play, have kick to kick with your mates at a park. Yep. If you're in that situation, then maybe you don't need a PT. You've got enough internal framework to actually do a good job of this yourself.
Yeah.
But there's plenty of humans out there that have the gym membership and go once a year at best and keep renewing, saying, no, this is the year that I'm going to pick it up. I'm not going to stop renewing until I go. And they end up now going 0 times a year, but still renewing. Like, you need a personal trainer.
And that's where general advice comes in. So in personal training, it could be YouTube videos and finding new workouts on YouTube. I'm just trying to do whatever
you're doing a good job, mate. Yeah, carry on.
But general advice for a financial advisor could be just generally saying, well, you can't access your super till you're 60 and you've got all these other objectives, or maybe you shouldn't be maximizing your super contributions too much, or maybe you don't need to make more tax deductible contributions because you don't have big taxable income. So all those kind of areas that we can talk about generally, I think, can be valuable from a financial advice perspective. And I think that's why we love doing these episodes as well. And you do have a faux pas for us here. Maybe I've used the wrong word.
Maybe, I don't
know.
But
an SMSF faux pas, can we call it? Maybe that's a new segment.
SMSF,
you've seen something go horribly wrong not horribly wrong, but not optimized. Let's say not optimized.
Yeah, so this came up not too long ago with some prospects that came to us. They have worked really hard to clear their debts. Power to you. The only debt they have left is on an SMSF investment property.
Yeah.
Now they are continuing to save at a pretty good clip, and they didn't really want to sit their money inside an offset, inside a cash account, and pay high marginal tax rate on it. And so they decided that it would be more appropriate to put the money into the offset account for the loan with the self-managed superannuation fund. And we were having this initial chat and going through their situation. I said, hang on, hold up. I'm just going to pull you up there. Let's go back a couple of notches. I just want to make sure I heard those words correctly. And they said, yeah, that's what we did. And of course, I can see from the look in your eyes, you know what happened here. That's a super contribution.
Yeah.
Your offset account for the self-managed superannuation fund is in the membrane of your SMSF.
Yeah.
And by putting money into that offset account, you have made a contribution into your SMSF, which means that you can't freely get it out anymore. That's a it's stuck. Now, thank goodness they had just by good fortune, they had done this very, very recently. And so what they were able to do is go straight back to their accountant and say, look, we've made a mistake. And the accountant looked at it, and then there was a process of essentially sticking their hand up to the ATO saying, hey, we've made an error here. And there shouldn't be any penalty, hopefully.
For a proper error.
For a proper error. This is a simple one. But hypothetically, had this have been left in there and that be the strategy for a couple of years.
Went through audit.
Yeah, that's right. And then said, okay, we'd like to get the money out. It's like that money's
Imagine
gone.
if you're in your 40s and you've done this,
They weren't They weren't old. Yeah, they were in a situation where it would have just been like nice that my I'm going to have a better retirement, but I've now, for all intents and purposes, got no savings at all because all of it's been going into the offset account. So this is just your friendly reminder, everybody. If you have an SMSF and it has an offset account, then please, you cannot put money in there as and use it as a traditional offset account.
Definitely not optimized.
No. But also a nice little reminder, if that when you make a mistake in your SMSF, if you accidentally draw money from the wrong account and then you want to get that fixed, stick your hand up as quickly as possible and announce the error, and more often than not, it can be resolved.
Yep.
So please get that addressed. Thanks for watching this episode of the podcast. A common question that we get at Rask is, how do I need to be prepared if I want to see a financial advisor? There's a few things that stand out that may really help you if you want to get the best from an advisory relationship. The first is to come prepared. It's really valuable if you can arrive at that meeting with a good sense as to what you want to achieve from an advisory relationship. Now, there's lots of different financial advisors out there that operate very differently. And if you don't have a good sense as to what you want to achieve, it can be kind of easy to get pulled into their advice philosophy and their approach. It can be hard to define what is the best advice relationship for me. So whether it's you or you and your partner having a good conversation to say, what do we actually want to get out of this? That will really, really help you to know that you're in the right place when you sit down with your advisor. The second one is to be open-minded. You may very well work out that there is one or two specific things that we're looking to address with our financial life. But a really good financial advisor is going to be thorough. They're not just going to look at those things. They're going to be as exhaustive as they can be about your entire financial life and make sure that everything is lined up and set up the way that it should be. So when you go into that process, please be open-minded that the highest value that you might get is not necessarily solving those one or two acute things that you wanted. The last thing is to be curious. If you are watching this podcast, it's probably because you are watching or listening. It's probably because you want to learn more about your finances. You want to level up when it comes to your education. And if you're going to meet with a financial advisor, it may be your first opportunity to transition that general knowledge that you've developed about your finances into your own situation and how it applies to you. So be curious. It makes sense for you to try to understand as well as possible, how do all these things work for me? Because at the end of the day, it's your financial journey and it's your money, and all of the advice should be helping to serve your unique situation. Now, if you want to learn more about how to get the most from your advisory relationship, you can either scan here, and that will take you to a guide that gives you a heap more information. Alternatively, if you scroll down below, there is a link to a Northeast Wealth page that we put together not too long ago, and that similarly outlines the key things that you should be doing in order to get the very most from the relationship. Thanks again for watching this episode of the podcast. I'm James O'Reilly from Northeast Wealth. We hope you enjoy it.
Sticking with super contributions, I've got a prickly one here, which comes from, sent in via the show notes. As always, please, click through the show notes and send questions in. We get so many questions every week. We just struggle to get through them all. And of course, go on the Rask community as well. This one comes from 3 years to preservation age, that being the age at which we can access our super. Can I reduce my super balance to under $500,000? An important trigger here. By withdrawing an appropriate amount, having met a condition of release and over 60 years old, as I'll be selling an investment property soon and want to use my catch-up concessional contributions to reduce my CGT bill. So the question here relates to the trigger. You have to have under $500,000 as of the prior 1 July and leftover unused concessional contributions. But can you take money out, having met a condition of release, to take advantage of this strategy?
Yes.
There we go. Done.
Let's move on. Well done to this individual. This is a really creative strategy, and a lot of people miss it. Yep. You and I, at one point in a previous podcast, were laughing about an individual who someone who got in touch with me that wanted to take out an insurance policy, but make sure the policy was finalized ASAP because they
reduced their balance.
That's right. They had all the money was in cash, and they'd moved it all cash to avoid market movement because they wanted to do catch ups the next year.
Yeah,
and so they put everything in cash, and they were still a little bit over 500, and they were looking at an insurance policy, but the debit would have to get taken pretty quickly.
Yeah.
So firstly, yes, it is possible. As you said, the ATO, they would take the view of this is basically just a gate that opens. If your super balance as at the previous financial year was sub 500, then and if you made a withdrawal, then it would be. then whatever's on MyGov, that opens the gate for catch-up concessional contributions. If your balance has gone above 500 and then lower with market movement or something like along those lines, then still it's available.
On 1 July, obviously,
as of
via MyGov.
As of that specific financial year.
Still my top recommendation ever, coming from January 2025.
That's right.
Log into MyGov.
That's aged like a fine wine, that recommendation.
Yeah.
When you did that, I must confess, I was like, come on, mate. Like, out of all of the things that we can do to improve your finances, the number one is create a MyGov account.
Yes, 100%.
And then ever since then, I'm just eating that in my own head. I'm
now, every client that comes into your office has probably set up their MyGov account.
Yeah, I'm like, oh, thank you so much. And like, thank Drew.
Yeah. Okay. But the other thing to hear, and I like bringing this up, is that if you're going to do a catch-up contribution, you have to lodge your
notice of intent to claim a tax deduction form.
Yeah, notice. Yeah.
Yes, please make sure you do that. And importantly, you have to do that before you have either A, completed your tax return, or if you are someone that completes a tax return very late, by the end of the following financial year.
That's something that can go so wrong so quickly, unfortunately.
Yes. Yeah, we had an issue recently with a provider where we submitted a notice of intent to claim a tax deduction form, and they said, no entiendo, we don't think we received it. We certainly didn't process it.
Just bring some Spanish in.
Yeah, just every now and then I like to pepper it.
Multilingual.
I'm extremely cultured, as you know. And so, so we had to go through a big hoo-ha with them to say, no, you definitely did receive it. Claro. And so in the long and the short is it all got reconciled, but it was, it was not fun.
Fantastic. And we're going to go a bit deeper on today's big question. And it's quite a unique one. I reckon I've had this question, not as much the last couple of years, and you'll understand why, but in almost every year before that. So the question comes from to switch or not to switch, and thank you for sending through anonymous names. Sometimes we get too specific a name, and this is obviously general advice only, not personal advice. We know nothing about people that are sending questions in. Would love to know your feelings towards how AustralianSuper's balanced fund performance has been over the last 3 to 5 years. I am feeling that they have missed the mark somewhat and have not been in the top 10 performers of late, with returns around 1 to 2% below their immediate industry fund peers. I know they changed to an in-house investment team around 2012 or 2013 and the results were initially good, but just feel they have not performed as expected of late. Also, are their fees too high for the balanced option? I mean, there's probably a couple of layers here, and I don't think we have to answer all of them at the same time, but there's a story about relative returns and return expectations when it comes to superannuation. How do you feel about this question? Is AustralianSuper you track regularly? I know in recent years, AustralianSuper was the number one performer, and every year we'd get the question from a number of clients would be, did you do better than AustralianSuper, or didn't you do better than AustralianSuper? And that was it. You get the same? Yeah.
It's a really common benchmark for a lot of Australians. It's the biggest fund in Australia. It has a lot of resources, even from an investment perspective. So it's a good question. Thanks for putting it through. There's a few things that I really like about this, and there's a few words of caution. The first one is that what I like about this is that you're making an evaluation over the last 3 to 5 years. Now, we've all heard that wonderful expression, past performance is not a reliable indicator of future performance. But that wording is very important. Often when I hear it, I hear that expression misused. Past performance is not an indicator of future performance, and that's not true. It is an indicator. If we had a particular fund A, which had previously returned minus 10% every year for the last 84 years in a row, there is some level of indication as to how they perform, but we agree that it's not reliable. It becomes more reliable the longer the time frame that you look, typically speaking. And so I'm grateful that this question is framed around the last 3 to 5 years. Very often we get the same question, but over the last 6 months, over the last 3 months, over the last 12 months it underperformed. Should I move from what was previously the best performer to now the
roll
current
over again?
Yeah, and the answer for that almost always is no.
Yeah.
You have to expect, especially with actively managed investments, you have to expect that even making good calls, you're not always going to get it right.
Yeah.
And in AustralianSuper's case, I haven't looked under the hood for some time with respect to the reasons.
You can guess.
Yeah. But let's go back to the horrible pain that is the CBA.
Yeah.
AustralianSuper might have they might have made the decision that when the CBA was at $120, that okay, we think we've seen enough here.
Like everyone was saying.
Yeah, that's right.
Including
everyone
you.
but you. Yeah. Correct. So they've said, okay, we're going to start reducing some of our exposure to CBA because it's wild, it's volatile, it's an unsafe investment. Why would any logical person be invested in this space? You'd have to be absolutely cavalier, crazy even to hold this at these valuations.
Hypothetically,
hypothetically. And so, but they have inadvertently stepped out of an investment that's then ramped on another 50%.
Yeah.
And because the CBA has such a heavy weighting into the Australian Stock Exchange, are currently 10% or thereabouts, that having a little bit less exposure to that is your 1% less return for the year, which is why they've hypothetically over 5 years done 8.79 or 7.79 instead of 8.21. It can be something that small. So for 3 to 5, good to be doing a longer time frame. And you're saying that you're feeling they've missed the mark somewhat, not been in the top 10 performers of late. Well, that's because they haven't been.
Yeah.
The question is, why have they not been?
Yeah. And I think that's the thing. One, in most cases, this is fine. Like your fund, you would never expect your fund to be in the top 10 every single year. And if they are, and circumstances have changed, it means they're probably taking more risk, or they're heading in a different direction to everyone else, which means they're prone to underperforming at some point. And that's, as you said, that's the nature of active investing, where you're not just buying the index. There have been, I think there's in Australian Super's case specifically, it did get a little bit, I think it was a bit more not complex, but they've had a bit of an overlay from the last few years. So we had something called Your Future, Your Super come in about 4 or 5 years ago. And we were talking about CBA, but this, due to the growing size and the mergers between all the super funds, there's a big focus on not underperforming the index significantly. So I'd suggest they're actually performing in line with their index, but they're not necessarily swinging for the fences like they used to, and thus being at the top of the performance tables every year. So Your Future, Your Super is basically saying if you consistently underperform the benchmark, any super fund, not just Australian Super or any My Super product, then the regulator can actually stop you from being able to attract new members to your fund. So there's been this natural tendency towards everyone holding very similar assets and the band of returns narrowing for better or worse for the industry. And in this case, you're talking about 3 to 5 years, but over that period, what you've seen, and I think you've highlighted pretty well here as well, is that Australian Super, due to their size being several $100 billion, has invested heavily into unlisted assets, into private markets, into direct property. And these things have had difficult periods as interest rates increased, as work from home increased. Not that there's anything specifically wrong with them, but the values of these things have slowly reduced while other parts of the market went significantly higher. And these are assets that are, well held. They're incredibly diversifying and valuable assets for very long-term investing, but it can result in some shorter-term volatility of returns.
Yeah,
but that's what diversification is all about.
I'd also be really curious to understand, if we had the opportunity to look back, let's say pre-2013, because that's in the question, talking about, in the past it was a very good performer and you feel as though something's changed. I'd be really curious to understand how that unlisted assets piece actually enhanced Australian Super's returns.
In that period, yeah.
Because I remember there was a period where they were very deliberate about when they released revaluations, not just Australian Super, but industry funds in general, like a lot of investments. They were
drop your discount rate when equity markets perform poorly.
Correct, yeah, that's right. And so you could, when equity markets were performing well, you would just let that run and you wouldn't revalue the commercial properties that you have, the unlisted assets. And then when equity markets perform badly, then you revalue and you get that spike and you end up with what's called smoothed returns. Yeah. And it meant that, especially in downsides, they could perform unusually well.
It was never zero.
That's right. So the rules on that have become a lot stricter. APRA have stepped in here and said, hey, we expect that valuations are going to be done much more regularly to ensure that that daily unit prices and crediting rates actually reflect what those valuations are. So I think that's eliminated some of the smoothing that might have happened in the past. And just to be clear, that's not just an Australian Super thing. My experience was that was across the board.
There's a lot of turnover on there. A lot of indexed options are at the top performers in the last 12 months and 2 years you the S&P 500 and the ASX have done it exceptionally well. What I find, and this is probably the last point I'd leave on this, is that when you see your fund drop out of the top 10, preferably you're not looking at the top 10, you're just looking at what your fund and your assets are doing. But what I find is that when people get to retirement and they're seeing the returns either decrease or be less clear or underperform against other benchmarks. I think what people want more and more is transparency. So going to seek, that's what we tend to get, people who want to know why it's performed that way, and then they might be more comfortable with what's happening. So I think it's seeking transparency. AustralianSuper has some, most funds have some, but I naturally see it at retirement. You want to know where your dollars are coming from, what's influencing it, why is it underperforming, why couldn't I be doing better, and what specifically is driving what income I'm going to have in retirement. I see that kind of more and more.
So on the whole, let's if you were in this person, like in your shoes, to switch or not to switch, looking at the performance, that would not be grounds enough for me to say, look, well, I've got to get out of here. Also, you're talking about your future, your super, the byproduct of that. I don't like that. I like the thinking around the legislation. I don't like the execution.
Yeah, it's too blunt instrument.
Yeah, and the issue, of course, if you're in the bottom quartile every year, if you're in the bottom quartile, then you need to send a letter out to all of your members saying, hey, we were terrible last year, and you might want to look at switching your super, which is hugely problematic because when members leave, often a lot of the costs need to be shared across a smaller member base, and so you can actually create this this rolling stone of higher fees and poor investment returns and so on. I like the idea of a report, but I think just doing it every year, for example, and not taking a long-term position makes sense.
Yeah, for sure.
Especially the being such to send out that letter. If you are let's imagine AustralianSuper had a year where they had to send a letter out to millions of Australians to say, hey, we underperformed. That will entice a lot of Australians to move when they didn't necessarily need to. That wasn't going to result in a better investment outcome. And so the byproduct of all this is that people play it safe. Investment managers, superannuation funds play it safe, and you're going to get a much higher concentration of performance,
similar returns
around the mean, especially taking the long term. So looking at that now in particular, I'd be less inclined in 2025 to want to make a switch because of a well-reputed industry super funds underperformance than I would have been in 2012 or 2013 when there could be some underlying risks being taken.
I think it's also worth reiterating what return expectations should be. Like we had it's been a crazy and fantastic period for investment returns, but we got used to this idea that a balanced portfolio that was split between growth and defensive assets could generate 10% every year. But realistically, and this is what I'd say about AustralianSuper or any other super fund, can it achieve the target return, which is generally CPI plus somewhere between 3 and 5%, or 6.5 to 7%. Can it achieve that? If it can still achieve that, and that's what you need for your retirement to be successful, then why would you change? Unless you have other priorities, you want more control, you want more transparency, you're worried about costs, or you want more, you want to have an ethical or some other bias that goes through it as well. But I think there are some great questions this week, and what we touched on, do you actually need financial advice always? And that was a great answer to that one. The little, maybe a faux pas is the wrong word for...
More importantly, do you actually need 2 Oasis tickets? Because if you do, hit me up.
Yeah, we touched on CBA. You can't use this to sell them at a premium either, can you? Maybe you can.
Personally signed.
Yeah, and of course we touched on whether it's worth switching your superannuation fund. So thanks for joining us, James. As always, an absolute pleasure. And we'll go get some ice for that hamstring and ribs, and hopefully we're recovered next time we're on air.
A lot of fun. Yeah, thanks, mate.
Thank you.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.